So when we are talking about psychology, then we are talking about the market trend, and we are talking about how the market can move actually in different terms of scenarios. For example, if you see this market trend on the daily, which is bullish, you see something like this. If you are so see this, this is actually psychological levels which we are placing right now. But in terms of psychology, then we need to look our market, how it's behaving on the different terms of different terms of levels of perspective, and anything we are looking at right now. For example, if I'm placing a buy over here, then I need to look at the price action. If it's breaking some levels which are respected in past, then we have a successful trade over here. And if it's not breaking the previous levels, then our psychology will be disturbed, and we will kind of go in emotional turn back, emotional turn back. Then we will emotionally open more trades, take more risks. And what will happen if we do that? We will eventually open more trades, and we will be in or four. Even though our stop loss is the same, we have a stop loss over here. Even if we have a stop loss, just a moment. Even if we have a stop loss over here, then we won't think about the risk we are taking, because once we open trade over here, then we will open next trade, the third trade, and the fourth trade. So this will lead us to a big drawdown, a big risk. This will make us lose about more than the percentage we were about to risk. For example, I'm risking 1% over here. Then if the trade is turning back on me, then I will be risking more and more, like 2% multiplied by 10, then is equals to 20%. So I will be risking 20% above 2% over here on my account. So that's a dangerous thing most of us do in our trading, which is concerned to psychology. That's what you call psychology, when you are risking more than you need to. And why do I want to trade? Took a buy over here. Why? What's the reason? The reason behind it is that we have this strong push. We have invalidated the structures from behind, right? And we are super bullish. Then we have taken some liquidity. Then market came into POI. Then I placed this buy. That's a simple term of placing a buy according to a structure. But if this zone fails, what will happen? Most of us will jump in more bias over here, more bias over here, more bias over here, even more bias over here, because we just want to get in. We just don't want to miss this buy move. That's the simple reason. But think about it. If this was not a break of a structure, if this was a liquidity grab, then what will you do? Then the market will just convert from here to bullish. It will become bearish, ignoring this trend also, ignoring this POI also. Then it will turn bearish, and on some scenarios it will do, then we will have some bearish POIs. So what I'm trying to tell over here is risk, as you have to risk according to your POI. Don't risk too much. If you got in more risk, then it will lead to a psychological problem that will be really dangerous for you. How smart money and dumb smart money behaves. according to simple trends. For example, smartest smart money buy over here on this POI. Smartest smart money buy over here. Which are the really smartest smart money? Why? Because this is the daily time frame. We are on a daily time frame. And if smartest smart money buy over here, then see the move, how they took it to the skies above 2000 ounce per unit on gold. From where? From this level, 1450. Okay. So in terms of smartest smart money, this is the move they will give you, or this move you have from this POI, this move you have from this POI. Okay. So that's what smartest smart money do. They will just give us a single move which will invalidate all of the structure of which was formed at behind, or which was formed at in the front. So on the simple scenario, if we look at the structure right now, we have this price. Let me just clear it. Okay, so we have this price which is behaving kind of weaker. You know, the price is weak to the downside, but don't just look at the weakness of the price. Okay, you need to look at the structure. If you look at the price, if it's weak, this price, let me just mark it out. No, not this rectangle. Yeah. Okay, so this price. Yeah. So this price is weak in terms of this price movement, right? This price is weaker. Why? Because we are seeing this a strong move on the first hand. Then on the second hand, we don't have that strong move which we are expecting. So what can you expect if the price is weak? You don't need to expect anything. You need to follow the simple market structure which it's leading to. So first of all, we had this reaction from this extreme, this POI, we have this strong reaction. How much pips do we drop from here? Basically, we dropped more than 2,500 pips, right? We dropped more than 2,500 pips. So what actually happened here? The price was strong, but to our eyes, the price is weak. The downside is weak because we have these small candles, these tiny little candles, which are in a consolidation state. So the price is weak in terms to our eyes, but it's not strong. It's strong to terms of the trend because it is a strong. It is a strong move. We have a single leg to the downside. Let me just mark it. Okay, yeah, we have a single leg to the downside, and the move is not over yet. Keep in mind, the move is not over yet. Why? Because we have not taken any liquidity which is laying over here. These lows are all liquidity. These lows are all liquidity. This is liquidity. Okay, we have triple bottom. If we are trading SMC, then these are triple bottom. This is not your everyday trade. This is a triple bottom, and which is a huge liquidity pool. We have a huge amount of stop losses below these triple bottoms. Okay, most of the traders are holding their buys over here. We have two kinds of smart money. which are a dumb smart money and the smartest smart money. This move was created by the smartest smart money. Then we have the dumb smart money, which was created by them this cell, because they are entering in a inverse, reverse trend against the trend. So they are the dumbest smart money. So that's another scenario that, and also if I am trading on a $1 million account, so I cannot even give a move to the market because I am not the single person who is trading with a $1 million account. In the world, we have most of the traders which are trading with a huge amount of money. That doesn't make us smart money. That doesn't even make us dumb smart money. Because even for this move, dumb smart money needs billions of dollars to make this move happen. What we have learned in market, that this forex market is a $1 trillion, above $1 trillion market, right? So we need more than $1 billion to make a single move, which will invalidate all of the retail traders. So my single account cannot make this move. My single account cannot make this move. My single account cannot make this move. Keep in mind. So this is all dumb smart money, because when you see, if I'm saying this is the smartest smart money move, then the dumb smart money will make moves. Sorry about that. Will make moves in internal range. We have studied about external range and internal range in SMC concepts. So these are the moves that are dumb smart money making. Retail traders cannot make these moves because these are also huge moves. Even on the 1 minute time frame, the dumb smart money is taking action. Okay, so these all moves are made by dumb smart money. Then we have this smartest smart money, which opened their orders, because if we are expecting this redistribution, then we need to look for how price is behaving, because if you look at it, we were in a buy trend, then we have booked orders over here. The smartest smart money booked their profits over here, because if they entered with a $1 billion lot size, then they will be booking their profits at the highest possible rate. And this is a premium price, because even if I'm going to market and I'm getting gold at the price of $2,074 per ounce, so I will be not interested in buying gold. If I'm doing an investment, then why will I need to buy gold at a premium price? Then I'll need to wait for the price to go down or be in a discounted price, right? Even if we buying grocery from the market, would you buy sugar, 1 pound of sugar in 50 bucks? Would you even buy 1 pound of sugar in 50 bucks? No, you wouldn't. You will wait for the price to go down in discount price, because that's a premium price. In the whole world, you get sugar for 50 pounds. I don't know what's the price in UK right now or in America, that how much they are taking for 1 pound of sugar. In Pakistan, we are just paying less than $1 for 1 pound of sugar. So that's the simple term that I'm trying to say over here. I don't want to buy gold at a premium price. Why? I will wait for gold to go in a lower price, a discounted price, so that I can buy gold, right? When it reaches a certain discounted price, then I will be interested in buying gold for a certain price, which will be respected in future, right? That will be a good investment. and I will be selling gold at a premium price, because if I'm holding a buy or I'm buying a stock, then I want to sell